Hello, friends. A lot of times in the middle of a divorce proceeding, I will get frantic calls from my clients saying, "Oh no, my spouse maxed out our credit cards right before they filed for divorce." Well, today we got you covered because we are going to talk about how the courts divide debt or liabilities during a divorce. Welcome back to the Divorce Broadcast. My name is Manny Segarra, coming to you from Miami, Florida. All right, before we get started, word of caution: do not assume that the only things that get divided in a divorce proceeding are the assets or the good stuff. Wrong. Remember that in a divorce proceeding, the court will divide both assets and liabilities or your debts. You don't just get to get stuck with the good stuff. It's just kind of like marriage. You get some good, you get some bad. So the way that the courts distribute or divide marital debts and liabilities varies upon the jurisdiction and the particular circumstances of the couple involved. So we're going to hop right into it. All right, in Florida, one of the first steps that is taken is to identify what the marital liabilities or debts are. The Florida statute 61.075 articulates or states what is considered a marital liability. According to the Florida statute, liabilities that are marital are liabilities that are incurred during the marriage individually by either spouse or jointly by them both. So what does that mean? That means that any debt from the date of marriage that either spouse incurs on their own or together with the other spouse are going to be considered as marital debt in a divorce proceeding. Remember that these marital debts have to be separated from non-marital debts, so that when you get to equitable distribution, the only thing that each of the parties will be responsible is either half or an agreed to amount of the marital debt, as well as their own non-marital liabilities. We're going to talk about non-marital liabilities next. All right, Florida Statute 61.075 also defines what a non-marital liability is, and it breaks it down into the following. The first non-marital liability is usually any liabilities incurred before the marriage. So once again, the date of marriage is the start date. Anything before would belong specifically to the spouse that incurred that debt. The second thing that is considered a non-marital liability is any liability that is excluded by a written agreement. Sound familiar? Well, it should. It means that it's either excluded by a prenuptial agreement or a postnuptial agreement. So let's say the parties are about to get married. One of the spouses comes in with some sort of debt. They sign a prenup, and the prenup says, "Honey, you keep your debt, I keep my debt." And that's how court will determine if it is non-marital. The next non-marital liability pertains to something shady, and the statute says that any liability incurred by forgery or unauthorized signature of one spouse signing the name of the other spouse. Any such liability shall be considered a non-marital liability. So in the cases in which one of the spouses forges the signature of the other, and let's say they buy a Lambo or a Porsche and they sign the other spouse's name, well, if they get divorced, that person who committed the forgery will be responsible on their own. And finally, any liability that is incurred by the spouses after the filing of divorce. So remember how we talked about the beginning, once the parties get married, the date of marriage is the starting point of all marital debts, while the ending point usually is the date that the divorce proceeding is filed. So that's a good way to clarify what the courts here in Florida consider to be non-marital liabilities. All right, now that we've explained what Florida courts consider marital liabilities versus non-marital liabilities, I thought it would be helpful to go over a list of liabilities that courts often divide in a divorce proceeding. And we're going to start with the most popular one. Usually it is the mortgage. Remember that a mortgage payment that is incurred in order to buy a marital residence or any type of investment or subsequent property by the parties is considered a marital liability. Number 2, the car finance or car lease payments. If a car was either purchased or leased during the course of the marriage, regardless of who purchased or leased the car, that is considered a marital debt. A little bit surprising for some people is credit card debts. That's right, if you're married and your spouse runs up a credit card bill because they are a shopaholic or they like to go on Amazon all the time, if they incur significant credit card card debt and a party files for divorce, that credit card debt is subject to distribution equally by the divorce court. Up next is student loans. I know it's a little bit of a touchy subject, but if you're one of those spouses that supported your other spouse, let's say you were the one that worked and the other spouse went to school and they had to incur student loans, well, guess what? If your marriage ever ends up in a divorce, then you will have to divide the student loans equally. Up next are any bank or credit union loans. Same concept. A lot of times the credit unions give you a better interest rate. Let's say that you're going to purchase a car, purchase a boat, make some bigger purchase, let's say some home improvements. If you take out a credit union loan, that is subject to equitable distribution by the court. Up next are loans on your retirement. A lot of people on their 401ks or their 457bs, they decide to take a loan on those plans, sometimes even on their insurance. Well, guess what? Those loans are marital liabilities and subject to distribution by the court, oftentimes equally. So watch out for those loans on your retirement accounts. Number 7 is medical bills. That's right. If your spouse either has an illness or an accident or some medical issues, let's say that they have a degenerative disease like either MS or rheumatoid arthritis or dementia, all of those medical bills are marital liabilities during the intact marriage. Also, judgments. Let's say that your spouse got into a car accident, or maybe they failed to pay a credit card bill, or maybe they have some other obligation that they were sued for and there's a judgment entered against them. Well, if that judgment is entered during the course of your intact marriage, that judgment is a marital liability subject to equitable distribution by the court. And finally, one of the scarier ones is IRS debt. That's right. If the couples file a joint tax return, the IRS debt is a marital liability that is subject to equitable distribution by the court. And a word of caution with the IRS debt, the IRS doesn't care who incurred the debt. They will come after both spouses if they're owed money. So don't mess with the government. Don't mess with the IRS. Moving on to business debts. Remember that the business may or may not be part of the divorce proceeding, so it depends on the type of business, and it may or may not be treated separately. Assuming there were no commingling of marital funds, we need to make sure that none of the marital funds were either used to support or finance the business, or that any marital efforts were used to increase the value of the business. If that is the case, then the business may be part of the divorce proceedings, and again, you just don't get the good stuff. You don't get just the value of the business. You have to offset it by the debts of the business as well as any liabilities associated with the business. Another issue that comes up oftentimes in a divorce proceeding is what's called dissipation of assets, meaning that the assets are either concealed or hidden. One spouse is obstructing the other spouse from being able to access those assets. Maybe they sell them. Maybe they're using marital assets or marital money for an extramarital affair. So if there is some sort of inappropriate behavior, let's say that one of the spouses empties out a bank account of $20,000, uses it on an extramarital affair, that $20,000 is a debt that is going to be assigned to the spouse that incurred in that bad faith or misconduct. So it's important to look at dissipation, because it's not just the debts like credit cards and car loans and mortgages. It's also any debts that are incurred by the party during the course of the proceeding that are done in bad faith. So as you can see, the overreaching point of this video to this point is that you have to account for marital debts. You can't just account for assets, because it can have a big swing on equitable distribution. For example, if the parties own a home and the home is worth $500,000 and there's a $200,000 mortgage on the home, you would normally think that there is $300,000 in equity left of that home, so each party is going to walk away with $150,000 worth of money or assets in their divorce. But it's not that simple, because you also have to look to see what debts there are. All of these liabilities will eat into the party's equity in the home, and instead of each getting 150, they would each get 150 minus whatever the liabilities are. So how do we safeguard and engage in preventative measures that may help us stay out of this debt trap and may help us avoid these significant liabilities that may be incurred by a spouse who either don't know what they're doing or may be engaging in misconduct or bad behavior? Well, number one, get a prenup. We've had many a video explaining what the importance of a prenup is, and as you saw in the Florida statute, 61.075 specifically excludes any debts that are excluded through a written agreement. So that means that if you have a prenup or even a postnup, then you're good. You don't have to worry about the other spouse either mismanaging debt or incurring debt you were completely unaware of. Number two, be very aware of your finances. It is imperative for you not to sit around like an ostrich with your head stuck in the ground. You need to be aware of what your monthly finances and your monthly statements are. So you got to take a look at the bank statements on a monthly basis, credit card statements on a monthly basis. You should be aware of all the different financial accounts. I know that retirement statements usually come out quarterly. Take a look at those. You need to be aware of the taxes that are being filed and make sure that you are present and ask the accountant to explain to you why the taxes are the way that they are. Also, if you find that your spouse is engaging in dissipation or waste of marital funds, monies, or assets, don't sit on your hands. A lot of jurisdictions have statutory limits as to when you can file for divorce and how far back you can go to try to prove dissipation. In Florida, it's about 2 years, according to 61.075, that you can go back and try to find unauthorized transactions. So you need to act quickly. Number four, if you file for divorce and you see that your spouse is either closing bank accounts, funneling money to other accounts, not paying for either the mortgage or the bills, you must file a motion for enforcement of either the status quo order or if the jurisdiction has a standing order. We did a whole video as to why status quo and standing orders are so important. So don't sit there. You have to be aggressive and you have to make sure that you are enforcing the status quo so that you can make sure that your money and your assets are not being wasted. And finally, mediation conferences. Those are huge. At mediation, you get an idea of what the finances are. In preparation for mediation, let's say there's a forensic accountant, you will be given knowledge about the finances. So use mediation, if you can't settle, as a form of getting information and the theory of the other person's case. A final note before we sign off on liabilities. Remember, it's important to note that even if a court assigns a certain liability to one spouse, both spouses may still be liable or legally responsible for that debt through the eyes of creditors. So if one spouse fails to abide by the agreement and continues or fails to make the payments on the liabilities, then the other spouse or both spouses can be in trouble. Prime examples are the mortgage. Let's say the husband is required to pay the mortgage and the mortgage is in both parties' name. Remember, mortgages last 15, 30 years. So it's safe to assume that maybe there may be a set time where the husband no longer pays the mortgage and it will affect the credit of both parties. Another example is the IRS debt. As I mentioned before, the IRS don't play and the IRS don't care. So if the couple owes a delinquency or money to the IRS and one of them doesn't pay, the IRS is going to come after both. So it's very important in the agreements that you have a prevailing party provision, meaning that if one of the parties has to take the other to court in order to enforce the agreement, then that party would be entitled to attorney's fees, and also an indemnification clause that requires the other party to defend them if one of the other creditor comes and goes after the other spouse. All right, so that's a wrap on the dirty little part of divorce proceedings, which is the liabilities. A lot of people don't like to talk about liabilities, but it is so important because they have such an effect on your overall equitable distribution. So if you know anyone that may find this information helpful, have them look us up at www.segarralawfirm.com. We have offices in Miami and Orlando, Florida. Se habla español. Do us a favor and like this video. Please consider subscribing to the Divorce Broadcast, and we'll see you next time. Thank you.